up, but okay, let's try it again. Welcome to Market Matters, presented by Mike's. I'm Joe Teagate. With me is Brian Stutland. Brian, you have a good weekend?
I did. Was just saying, I really want to get into our show talking about crude oil, what that means. It's such an important factor that plays in the global economy, but it also has a lot of impact on stocks.
Yeah, it absolutely does. And it's crucial to volatility. And it's even more so in the current environment when things are so sensitive on interest rates and so sensitive to the inflation expectations. So let's take a look into it. On the economic reports this week, there is a lot of Fed speakers going on out there. Pretty much they all are coming out. Maybe they're going to be, throwing some cold water on what Powell said last week. I think it's more likely that they're going to be reiterating what Powell said last week, basically saying, hey, everyone, we're going to cut rates. There has been some softening in the economy and inflation is under control. Powell basically saying, hey, we're going to cut rates this year. Get ready for it.
Yeah, but really the big story, NVIDIA, Wednesday after the close, we have a trade on that later in the show. That's obviously going to be a big market mover. We talked about it last week on a bunch of our topics that we have out there in the media about how important the semiconductors have been, really leading the charge in this rally.
Yeah, NVIDIA is the market this year. I think if you don't own NVIDIA, you have to pay attention to this report because the market's going to move with NVIDIA, either a good news or bad news. The market's go down if NVIDIA goes down and up if it does. So everybody needs to be paying attention to that. Speaking of which, the market is very comfortable right now, Brian. This is the lowest levels we've seen in volatility in this curve all year long. So low in this volatility. Heading into these summer months, this is maybe a sign of complacency, maybe something that people should concerned about. But right now, it seems like nobody has any worries to the downside of the market.
Yeah, I mean, it's a pretty bullish sign right now, actually. The fact that these volatility futures keep falling, as you can see here, we're not seeing where the market is rising and then all of a sudden volatility is starting to get bid up and we start to see these people out there buying insurance on their portfolio. It's actually quite the opposite. The market's rising, and if anything, people are buying a call or they're selling a put. We don't really see it in the major indexes where there's this factor of people wanting to own some sort of protection. And you can see right here in the skew index that we like to look at. This is sort of an indicator report. Maybe it's upticked a little bit off of its low, but to me, we're not seeing this uptick in put buying, that happens in this skew index. The skew index increases in value when hedgers come into the marketplace. That would be concerning to me. When we see put buyers come in and the market's still making new highs, then I'd start to worry that institutional order flow is wanting to put on some sort of hedge, but we haven't seen that. So to me, low levels of volatility may be good for the market. Maybe the market can continue to grind higher.
Yeah, and volatility is a contrarian indicator only when the market tops, really. And, last week we were pointing this out. If you're interested in the skew index, make sure to follow us. We're watching this every week. Last week we were right here, Brian, and we were saying, oh, it's ticking up. If we get above here, I'll be concerned. I'll have some issues to the downside in the market. That didn't happen. Powell came out and said, hey, we're getting some rate cuts. The skew index made a new low. I think at this point where we are here, we're ticking up again. If we break this here and make break this relative high here, I think we should be watching, have our head on the swivel, looking for something else in the market. But until then, as long as we're making lower highs here, I think the market should be a smooth sailing. And one thing we looked at last week, Brian, we didn't really mention on the show, was how closely volatility has been tracking oil. And this is going to lead us into our big story, Brian, about how the market's so focused in on these geopolitical concerns. We're not so worried about the economy, but we are concerned about oil and a shock to oil triggering some sort of economic slowdown here in the U.S. But look at this, how closely volatility is tracking oil over the past year here.
Yeah, I mean, if you follow us on X, we've been talking about this last week, about this oil volatility correlation that they make with each other and how much an oil shock forces people into volatility, gets people concerned about the market. And now, I mean, if you look at this chart here, Joe, I mean, you see oil sort of kind of remaining bid here. So it's a little bit of a worry that is volatility going to spike up and catch back up to oil? Or is oil going to continue to decline here? Is the Fed going to get some of this inflation stuff under control and you'll see oil trend lower, and then that'll allow volatility to stay, pretty low, option prices stay low, people feeling good and buying the stock market?
Yeah,
as a rollover ripple effect.
There's no question, right here we had the Iran-Israel back and forth going on where oil ticked up a little bit. There's no question there was palpable fear that could trigger some sort of spike in oil, triggering something else in the U.S. economy. I think there's just been a sigh of relief since then, but it's just important to watch. And let's dig in a little bit deeper, Brian, over history, why that's so critical. Now, we know it's not a big secret, right, that when the 210 curve is inverted, like it is now, 10 times out of 10, there's a recession coming, and you don't really know how long that will be. But what people kind of don't think about is when we are in these inversions, like these spots here, and here, and here, the market doesn't actually do terrible. It's not like things are free falling. It's only when things start to re-invert. That's when the stock market starts to go lower. So we're talking about right here and right here, like two major instances. Of course, here yet in 1992, we started to re-invert. The curve started to go a lot higher. People were expecting the short-term rates to fall quickly because they could see the economic data weakening, which means weak economic data, bad for stocks. And we got more charts to back this up here, Brian. So look at this. This is the 210 right now. Okay, now it's critical, of course. This spike right here was when you had the Silicon Valley Bank and the regional bank crisis right here, and that was the worst spot of the market for 2003. And then it just had a tremendous rally in the market until this bottomed, right? So this getting more inverted was really good for stocks. Of course, it happened again. The market sold off through into October. It got more inverted in November, and that was really good for stocks. So we should be worried about this going higher, right? So this is the last 2 years. This is what it looked like back in 2007, 2006. Looks kind of similar. What's it look like right now with oil? Again, oil is kind of leading this yield curve inversion. Same with the volatility. It looks very similar. The same was true in 2006, 2007. But what we should be worried about, Brian, why oil is so important, and maybe people kind of forget this, is kind of lost. What really triggered the slowdown in 2007, everyone knows there was a housing bubble, but really triggered it all off, which really popped the bubble, was oil going to $140 a barrel out of nowhere. Maybe it was China's growth. Maybe it was just some weird thing. But that spike in oil started this recession in the U.S., which really blew up the housing bubble.
Yeah, I mean, let's take a look really. If you look at sort of this bottoming pattern that oil made, this head and shoulders bottom back at the end of 2006, early 2007, it started rising, right? So what was really concerning was rising oil and re-inversion of the yield curve occurring at the same time together and moving rather significantly. So to me, Joe, actually, if the Fed cuts interest rates, I know people want 2, maybe 3 cuts. I think if they cut at all, that's actually pretty bearish for the market, because that's a sign that the Fed is sort of throwing in the towel to say, look, we held interest rates high enough for long enough. We need to cut because things are slowing down. And if we don't do it, cut fast enough, if we cut, let's say 2 times, it's probably pretty bearish because it means things are really slowing down. Then you couple that, if that doesn't control inflation, if that rate cut causes oil to continue to move higher, it causes commodity prices to move higher. You've got the hurt of both worlds occurring that occurred back 2007 timeframe, where both oil and the inversion of the yield curve happened together. That's, I think, very bad for stocks, and that's something to watch out with. But Joe, maybe you could talk about maybe some levels here in oil that we're watching to sort of get above, along with an re-inversion of the yield curve.
Yeah, and you can see here back in 2007, broke above $80 a barrel here. It came down and tested that, and then kind of broke out. The market said, "Oh no." And that was the top of the market in 2007, this October right here. This is the top of the market. Didn't see a new top for another 6 years. So
are we there yet? Are we there yet right now? Is this something that is correlating? I know we look at 2006, 7. To me, I'm not sure if we're quite there yet, but this is a signal that we're very closely watching.
Yeah, so I think that spot that correlates with $80 in 2007 is right here, this $92 a barrel here. If we break out, if this turns into a bottoming formation here, and if we get above here, and then, confirmed above here, I think the market's in big trouble. I think the economy will not be able to withstand that. We're already at the point where, the economic data is a little weaker. There's some good data, some bad data. We get above here, it just breaks everything down. Everything is more expensive. The economy won't be able to take this double whammy of these higher interest rates and this higher oil.
When we've had a 2% down move in the market over the last 3 to 5 years, let's call it, the average move down is about 8%. So I just want to create some protection in here that's going to give me some protection against a quick, volatility shock to the marketplace where you get a pullback and not have to worry so concerned about a huge bear, massive recession sell-off yet. So I'm not too concerned about that yet, but I am watching some of these levels to say, wait, maybe I need to add more protection than just against a 5% move to the downside. Maybe I need to pick up some more volatility or VIX futures contracts or however you're going to trade it. But that's something that we sort of manage with clients and figure out. And so right now we're kind of looking in that 5 to 10% risk to the downside to get these little volatility shocks. Other than that, I think things are pretty rosy right now for the stock market, but I am watching, I think a Fed cut where people might feel good about that. I think I'm going to feel pretty bad about that, especially if oil moves higher on a rate cut.
Yeah, bottom line is I'm not really concerned as long as we're below this $92. I think if we get above here and are confirmed here, I think it makes a lot of sense to be a lot more defensive in our positioning for our portfolio because we are at this critical spot where all the cards are lined up for them to be just knocked over with this higher oil. So it's very dangerous if we do get this oil. As it is, we're still in the sweet spot. If the economy stays, good enough, the Fed hasn't cut yet. I think the market's in a good spot. Plus, we have the AI revolution bringing on new productivity and new areas of growth. So as it is, there are still partially market to be excited about. It would just be a huge red flag if oil does break above here and is confirmed above here.
Yeah.
But speaking of the bright spots, Brian, big earnings event this week, which we are looking forward to. We mentioned it earlier, is
NVIDIA. Yeah, that's been the market mover. NVIDIA. It's one we put on a trade actually. About 2 weeks ago now, and it's really actually kind of paid off. Where you see here we paid $6.50 for that spread. It's now worth about $24 based on where NVIDIA is. So, Joe, do you have any ideas how to remanage this position? What you're looking for in terms of the earnings picture and where the stock could go?
Yeah, so we talked about how we want to trade this. I think we still want to watch it. There's a few options, pardon the play on words here, for us to. I think it makes sense to look at cutting some deltas into this event. One potential way to do that would be to be buying a put spread. Another way to do that would be to selling a call spread. We could just take it all off and say, we had a 300% winner. That's good enough for me. But I think I like NVIDIA here. This chart really does look like it wants to break out, and I think I might want to keep that position on. If you look at this cup and handle here, maybe head and shoulders here, coming up into this all-time high, it really does make sense to think that, boy, this really could want to make a new all-time high and break out. But, a lot can happen before earnings. We were up $25 today in NVIDIA. Maybe we're up another $25 tomorrow. I think if that's the case, maybe then kind of make a decision. Again, sometimes you get these moves up here and everyone jumps on board. You get some FOMO. And then if we break back below here, it becomes a very quick move down. So that's something I would want to protect against for sure. So our position's all in options. So I would think owning a put spread ahead of earnings makes a lot of sense. Very defensive, locking in some of this gain. We looked at the 900, 850 put spread, kind of turning the downside position into a fly, where the sweet spot would be right about here at 850. 900, 850, 800, 750 fly kind of would be where it would be. That would cost us about $13 right now. Given where we are ahead of earnings, it's very expensive to do that. So I really want to just kind of wait and see ahead of tomorrow's earnings. Another possibility, Brian, we looked at selling some call spreads, either the 1,010.50 or the 1,1100 call spread, maybe turning it into a smaller call spread or an upside iron condor. where we just look for a sweet spot between 1,000 and 1050.
Yeah, I mean, I don't think I'd want to give up the upside on NVIDIA at all. I think like if this chart really depicts if we break above 950, I think it can go. Maybe you're right. It could snap back and be kind of a wicked move down. I think the right move is just to own a put spread. Like I really like the 900 850 put spread. It's pretty cheap. It gives me some protection in case the market sells back off and help like protect some of these gains I've made where we're up, 300%, like you said, on the spread trade that we initially put on. And remember, by the way, we're also collecting interest because we've been holding cash. We haven't had to outlay money to buy NVIDIA stock, right? So we're actually up $1 or $2 on that as well. So remember here, yes, it's a little expensive. That's why I'll do it as a put spread. And, the sweet spot being that 850 mark, could NVIDIA fall back to there if earnings sort of disappoint? But, all basically every tech earning, the big four, the mama stocks, I like to call it, Microsoft, Amazon, Meta, Alphabet. And yes, I'm excluding Apple on this, but obviously they're spending too. But those four that are really developing that regenerative AI kind of models have all said they're spending money, right? And that money's got to be earmarked for a NVIDIA kind of place to get more chips, be faster in responding. And so to me, I want to protect below that 900 mark. And if we sort of break out above this 950, I might buy a put spread just to hedge in case that rebound reflection comes back like you talked about. If we fall below that 925 mark, I might have a stop in to buy the put spread as a way to sort of, because maybe we broke down below that little purple support line now and maybe we're headed lower. But that's kind of how I'd be watching it.
Yeah, so that just adds a little bit to the cost when you're doing that protection. That makes sense given how volatile this name is, and it really cuts your risk to the downside. Basically takes it off completely off from my point of view. I don't think we're going to be sticking here at 950 come Thursday. So I think this is going to be we will move well off of this level. So I think you look really pretty at 850 and you look fantastic at 1050. So I like this, but I might change my mind Wednesday before the close. Depending on where NVIDIA stock is, for sure.
Yeah, so we'll definitely give you an update. Remember, these options expire at the end of the month, so it's something you've got to kind of react to. If I'm going to trade it, I'm going to make some adjustments after the earnings report comes out, so that I don't just see things expire off that I don't want to, or I want to get out of some risk or something like that. But this has been a great show, Joe. I think we covered a lot here, a lot between the oil and interest rates. NVIDIA, obviously a big play on Wednesday. Stay tuned. We'll give more updates on Twitter. But most importantly, Joe, we have nothing going on next week. Monday, Memorial Day, we're off, right? And we're super excited to relaunch the show the following Monday afterwards. Am I allowed to tease the new name that we're going to call the show, or not quite yet?
Stay tuned, I would say. The big announcements coming will be, make sure you tune in Monday, 2 Mondays from today. That'll be June, what day is that?
June 2nd, 3rd, something like that. But yeah, we're kind of revamping the show a little bit. It's going to be awesome. We're bringing even more to you, better graphics, better information. We'll be coming at you, and we're super excited about it. So that just about wraps it up. I'm Brian Stutland of Equity Armor Investments. This is my colleague, Joe Tigay. We're bringing you Market Matters, sponsored by the MIAX. And stay tuned for the big announcement. We'll get you on, and we'll see you in a couple weeks.
All opinions expressed by Trader Hub contributors are solely the contributors' opinions and do not reflect the opinions of Trader nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Trader nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Trader Inc. is the parent company of Trader Brokerage Inc. Trader Brokerage Inc. and Trader Inc. are separate entities with their own products and services. Securities products and services are offered through Trader Brokerage Inc. Trader Brokerage Inc. is an independent subsidiary of Trader Inc., all rights reserved, member FINRA SIPC.